In 2008, the global financial system nearly collapsed. Banks that had stood for over a century vanished in days. Trillions of dollars evaporated. And at the center of it all was something that shouldn't have been worth anything at all: debt. But here's what doesn't make sense. The people who created the most debt, the people who should have lost everything, they got richer. The institutions that failed were rewarded. And the system that broke was rebuilt exactly the same way. How does that happen? How does owing money become more valuable than having money? And why did the people who understood this make fortunes while everyone else paid the price? This is the story of how debt became the most profitable commodity in history. And by the end of this video, you'll understand why the same pattern is happening again, right now, and why almost nobody is talking about it. To understand how we got here, we need to go back to a time when debt wasn't a commodity at all. It was a burden, a risk, something you wanted to avoid. For most of human history, if you loaned someone money, you were stuck with that loan. If they didn't pay you back, you lost. There was no one to sell the debt to. No market for it. You just had to hope the borrower would honor their obligation. Banks operated under this simple principle for centuries. When you deposited money, the bank loaned it out and collected interest. The bank made money on the difference between what they paid you and what they charged borrowers. It was straightforward. Boring, even. But in the 1970s, something changed. The United States went off the gold standard in 1971. For the first time in modern history, currency wasn't backed by anything physical. It was just numbers. Promises. And that opened a door. Because if money is just a promise, then debt is just a promise about a promise. And if you can trade promises, well, you can trade anything. The first person to truly understand this was a man named Louis Ranieri. He wasn't a famous economist or a Wall Street titan. He was a bond trader at Salomon Brothers who had started in the mailroom. But Ranieri saw something others didn't. He looked at mortgages, thousands of them, sitting on bank balance sheets, and he asked a question that would change everything. What if we could package these debts together and sell them like stocks? The answer to that question would create fortunes, destroy economies, and fundamentally transform how money works. But to understand why, we need to understand what happened next. The origins. The birth of securitization, 330 to 645. The year was 1977. Louis Ranieri and his team at Salomon Brothers were working on something that had never been done before. They called it securitization. Here's how it worked. A bank gives out 1,000 mortgages. Normally, those mortgages just sit there, earning interest slowly over 30 years. The bank's money is tied up. They can't do much else with it. But Ranieri's idea was to bundle all those mortgages together into a single package called a mortgage-backed security and sell it to investors. The investor buys the package and receives the monthly mortgage payments from all those homeowners. The bank gets its money back immediately and can loan it out again. Everyone wins, right? The bank gets liquidity. The investor gets a steady return. Homeowners get access to more loans because banks have more money to lend. The first mortgage-backed security was issued in 1977. It was a modest success. But the real breakthrough came in 1983 when Ranieri helped lobby Congress to pass the Secondary Mortgage Market Enhancement Act. This law made it easier to create and trade these securities. And that's when things accelerated. By the mid-1980s, billions of dollars in mortgages were being packaged and sold. Then tens of billions. The market was growing exponentially. And here's the critical part. The people creating these securities realized something profound. They realized that debt, when packaged correctly, could be made to look less risky than it actually was. You take 1,000 mortgages. Some borrowers will default, sure. But statistically, most won't. So the package as a whole seems safe. Safer than any individual loan. And if it's safe, you can sell it for more money. You can charge higher prices. You can create more of them. Debt wasn't just a burden anymore. It was a product. A commodity. Something you could manufacture, market, and profit from. But there was a problem lurking beneath the surface. A problem that no one wanted to acknowledge. Throughout the 1990s and early 2000s, the debt securitization machine went into overdrive. Mortgage-backed securities were just the beginning. Wall Street firms realized you could securitize almost anything. Car loans, credit card debt, student loans, commercial real estate. If someone owed money on it, you could package it and sell it. But the real innovation came with something called collateralized debt obligations, or CDOs. These were like mortgage-backed securities on steroids. Here's how they worked. You take a bunch of mortgage-backed securities, slice them into different tiers based on risk, and repackage them into a new security. The top tier gets paid first and is considered safe. The bottom tier gets paid last and is risky. And the middle tier? Somewhere in between. Now here's where it gets interesting. The top tier of a CDO, made from medium-risk mortgages, could get a AAA rating, the same rating as U.S. Treasury bonds. The safest investment in the world. How? Because the rating agencies, Moody's and Standard & Poor's, used mathematical models that said, even if some of the underlying mortgages default, the top tier is still safe because it gets paid first. But there was a catch. The models assumed that mortgage defaults were isolated events. That if one person couldn't pay their mortgage in California, it had nothing to do with someone else defaulting in Florida. The models assumed housing prices would keep going up, or at worst stay flat. The models assumed the past predicted the future. And Wall Street firms paid the rating agencies to rate these securities. The agencies made more money the more CDOs they rated. There was no incentive to be conservative. No incentive to ask hard questions. So they didn't. By 2006, the market for mortgage-backed securities and CDOs had grown to over $3 trillion. Banks were originating mortgages not to hold them, but to immediately package and sell them. If the borrower defaulted, it wasn't the bank's problem anymore. It was the investor's problem. This created a perverse incentive. Why be careful about who you loan to? Why check if they can actually afford the house? You're not keeping the risk. You're just selling it to someone else. And so lending standards collapsed. Ninja loans became common. No income, no job, no assets. Didn't matter. You could still get a mortgage. Meanwhile, the people creating these securities were making unbelievable amounts of money. Traders at investment banks were earning 8-figure bonuses. Hedge fund managers were becoming billionaires. They weren't creating value. They weren't building anything. They were just moving debt around, slicing it, repackaging it, and selling it for more than they paid. And everyone believed the party would never end. But it did. The first cracks appeared in early 2007. Housing prices, which had been climbing for years, started to flatten. Then they started to fall. Suddenly, the assumptions in all those mathematical models were wrong. Mortgages weren't isolated risks. When housing prices fell, they fell everywhere. People who couldn't afford their mortgages started defaulting. Not one at a time. All at once. The bottom tier of CDOs started failing. Then the middle tier. Then, impossibly, the top tier, the AAA-rated securities that were supposed to be as safe as government bonds. Investors around the world held trillions of dollars in these securities. Pension funds, insurance companies, foreign governments. And suddenly, no one knew what they were worth. In August 2007, French bank BNP Paribas froze withdrawals from 3 investment funds because it couldn't value the mortgage-backed securities they held. The debt market seized up. Banks stopped lending to each other because no one knew who was holding toxic assets. Bear Stearns, one of the oldest investment banks on Wall Street, collapsed in March 2008. It was sold to JP Morgan Chase for $2 per share. A year earlier, it had traded at $133. In September 2008, Lehman Brothers, another Wall Street institution, filed for bankruptcy. It was the largest bankruptcy in U.S. history. $600 billion in assets gone. AIG, one of the world's largest insurance companies, was on the verge of collapse. The federal government stepped in with an $85 billion bailout. Then $85 billion more. The stock market crashed. Credit froze. Companies couldn't borrow money to make payroll. The global financial system was hours away from complete collapse. And here's the thing that still shocks people when they learn about it. The total value of actual mortgages that defaulted was around $250 billion. Bad, yes. But the financial system lost over $10 trillion in value. How does $250 billion in bad loans cause $10 trillion in damage? Because the debt had been turned into a commodity. It had been leveraged, sliced, repackaged, and sold dozens of times over. Every dollar of actual debt had been turned into $5, $10, $20 of securities built on top of it. When the foundation cracked, the entire tower collapsed. In October 2008, the U.S. government passed the Troubled Asset Relief Program, or TARP. $700 billion to bail out the financial system. The largest government intervention in the economy in history. The Federal Reserve dropped interest rates to near zero. It began buying assets directly, a program called quantitative easing. Over the next several years, the Fed would pump over $4 trillion into the financial system. Meanwhile, millions of people lost their homes. Unemployment hit 10%. Retirement savings were decimated. Entire neighborhoods were abandoned, houses sitting empty with foreclosure signs. But here's what's shocking. The people and institutions that caused the crisis came out ahead. The big banks that survived absorbed the ones that failed, becoming even bigger. J.P. Morgan Chase bought Bear Stearns and Washington Mutual. Bank of America bought Merrill Lynch. Wells Fargo bought Wachovia. The executives who ran these firms kept their jobs. Some kept their bonuses. Nobody went to jail. Not one major Wall Street executive was criminally prosecuted for the crisis. And the system itself? It wasn't dismantled. It was saved. The Dodd-Frank Act, passed in 2010, added regulations. More oversight. Stress tests for banks. But the fundamental structure, the ability to securitize debt and trade it as a commodity, remained intact. Why? Because debt as a commodity had become too central to how the global economy functioned. Too many institutions, too many countries, too many pension funds and insurance companies depended on it. The system was too big to fail, and therefore it was too big to change. But the cost of saving it was enormous. Government debt in the United States exploded from $10 trillion in 2008 to over $16 trillion by 2012. That debt was paid for by taxpayers, by inflation, by a decade of economic stagnation for average workers. The people who created the crisis were rescued. The people who suffered from it paid the bill. And the machine kept running. Now let's talk about today. Because the same patterns are happening again. Global debt has reached $315 trillion as of 2024. That's 3 times global GDP. Governments, corporations, and households owe more money than the entire world economy produces in a year. Corporate debt in the United States is at record highs. Companies that barely turn a profit are borrowing billions. Why? Because interest rates, until recently, were historically low. Money was cheap. Debt was easy. And that debt is being securitized, packaged, sold, just like before. Collateralized loan obligations, or CLOs, are the new CDOs. They package together corporate loans, slice them into tiers, and sell them to investors. The market for CLOs is now over $1 trillion. Sound familiar? And here's the kicker. The same rating agencies, using similar models, are giving these securities high ratings. AAA. Safe. Even though many of the underlying loans are to companies with junk credit ratings. Student loan debt in the United States has passed $1.7 trillion. Most of it is held by the federal government, but private student loans are also being securitized and sold. Auto loan securitizations have exploded. Even subprime auto loans, to borrowers with terrible credit, are being packaged and sold to investors. The lesson from 2008 wasn't learned. It was ignored. Because debt as a commodity is too profitable. The fees for creating these securities, the bonuses for selling them, the returns for trading them, they're too large for the system to give up. And central banks around the world, including the Federal Reserve, are caught in a trap. They raised interest rates to fight inflation, but higher rates make all this debt more expensive to service. Companies that borrowed cheaply are now struggling. Defaults are rising. If rates stay high, the debt bubble pops. If they lower rates, inflation comes back. There's no good option, because the system is built on a foundation of debt, and that foundation is cracking again. So what can we learn from this? First, debt became a commodity because it could be hidden. When you package thousands of loans together, slice them into pieces, and give them complex names, no one can see the risk clearly. Complexity is profitable. Transparency is not. Second, incentives matter more than regulations. As long as the people creating and selling debt securities make money whether the loans succeed or fail, they will prioritize volume over quality. Until individuals face real consequences, the behavior won't change. Third, the system protects itself. In 2008, we learned that when financial institutions become large enough, they cannot be allowed to fail. This creates moral hazard. It encourages risk-taking because profits are private, but losses are public. And once a system reaches that point, reform becomes almost impossible. Here's the uncomfortable truth. Debt as a commodity isn't going away. It's too embedded in the global financial system. Too many powerful interests benefit from it. But that doesn't mean you have to be blind to it. Understanding how debt is packaged, sold, and hidden gives you an advantage. It helps you see the warning signs, the bubbles forming, the risks building, because the next crisis won't look exactly like 2008. It never does, but the pattern will be the same. Debt growing faster than the ability to repay it. Complexity hiding risk. And when the music stops, the people who understood the game will protect themselves while everyone else pays. The question isn't if it will happen again. The question is when, and whether you'll see it coming. If this video changed how you think about money and debt, hit that like button and subscribe for more deep dives into the systems that shape our world. Drop a comment below with your thoughts on where you think the next financial crisis will come from. Because one thing's for sure, history doesn't repeat, but it sure does rhyme. Thanks for watching. I'll see you in the next one.